Okay, well, let's go ahead and get started. I'm sure that more folks will join as we move along, but you're at Tax Time Tips 2020 with the Indiana Arts Commission and our good friend Elaine at Minerva Financial Arts. I'm Anna Tragister. If we haven't met yet, let's meet. I am the Artist and Community Services Manager at the IAC, and that means that um, I'm here to support you and connect you with resources for your creative career and life as an artist. We have several grant opportunities available throughout the year, as well as a couple of educational opportunities in person, like the Indiana Arts Homecoming and the On-Ramp Creative Entrepreneur Accelerator, which Elaine is actually our course instructor and co-host of. And also then just a few different opportunities for webinars like these throughout the year. So if you haven't yet, go back and check out Elaine's retirement tips for creatives. And we also have another webinar about building your website with the user in mind with another arts and digital media pro, Erin Gansey from Heron School of Art and Design. So without further ado, I know you're dying to talk taxes. So let me introduce you to Elaine Grogan-Luttrell.
Thanks so much, Anna. Thank you, everyone. Welcome. I'm really excited to be here tonight talking about taxes. It is the season after all. Of course, this sort of programming would not be possible without Anna and the entire Indiana Arts Commission. So huge thanks to them for supporting the education and empowerment of creative individuals in the Hoosier State. As Anna said, my name's Elaine. I love working with the Indiana Arts Commission. I run a company called Minerva Financial Arts that helps empower creative individuals, specifically when it comes to financial matters. And we do that through education and sort of counseling and one-on-one support as well. So it is really, really wonderful to be here tonight. I am the luckiest CPA ever because in addition to working with the Indiana Arts Commission, I get to work with incredible groups all over the country. So it really is a pleasure to be with you all tonight. So thanks for joining us. So what are we doing? Well, we're talking about taxes, of course. And if you're familiar with the Zoom platform, then you probably know kind of generally how this works. There is a chat box you can find, and I would recommend that you go ahead and open that up. That way you can make sure to put your question into the chat box whenever it makes sense for you, or if something strikes you or you want me to make sure to address something or to answer a question in real time, the chat box is going to be the best way for you to do that. You'll see my slides are on the screen, so that's what you're looking at as we go through this presentation, and you can see my video, and you're welcome to turn on your own video if you'd like us to see you, or you can just hang out and listen and relax this Thursday evening. You also may want to keep yourself on mute so we can cut down on any background noise, and if you would like as well to ask a question, if you want to raise your hand like Anna has just done, we can make sure to acknowledge that and invite you to unmute yourself and ask the question. So go ahead, Anna, what did you have on your mind?
I should have mentioned that, but we are recording this and we'll send out the recording as well as any follow-up information right after the webinar to anybody who attended and also just everybody who's interested.
Yes, wonderful. Thank you so much. I appreciate that. And a great demonstration of using the raise your hand tool. So feel free to play around with those buttons. I promise you will not break Zoom as we go through this. You'll be totally fine. So make sure you're getting what you need out of our time together. So very specifically, beyond just talking about taxes, we've organized the content tonight to cover sort of in general how income taxes work, paying particular attention to the different types of income that creative individuals often have and where they end up going on the tax form and why it matters. We'll also talk about common deductions that creative entrepreneurs generally claim or are able to claim. And then we'll spend some time talking about the types of information you need to save in your records, how long you have to save them, and then talk about some strategies for using your process this year to improve your records for the rest of 2020 so that when you file next year's tax return, it'll be smooth sailing and very easy and good to go. A quick disclaimer, this information is for educational purposes only. We are recording this, so you'll be able to review the information at a later date, but do know that tax laws change pretty regularly, and there are lots of unique specific circumstances that apply to individuals. So your best bet is going to be to talk to a professional that knows all the details about your very unique situation. We also want to take a moment just to acknowledge some ground rules. We want to make sure that everyone has a chance for their voice to be heard, whether in the chat or out loud if you'd like to unmute yourself and contribute. But we do want to make sure we're sharing the floor with respect. If there is a question you're not comfortable sharing with the group, you can always feel free to send it to me in the chat privately, or you can follow up and send it to me via email afterwards, and we can correspond that way. Of course, we are all experts in our own experience, so not everything I'm going to say is going to resonate perfectly with you, but that's okay. You get to take the information that works and sort of edit out the rest. And lastly, of course, the stories stay, but the lessons leave. So on the off chance that someone does want to share a personal anecdote, just remember that anecdote is that person's to share, but you should absolutely take the lesson from that anecdote or story and carry that lesson with you. So let's start with a big picture overview. How do taxes work? This is a simplified visual presentation of the federal income tax system in the United States. And I have edited out a lot, right? So this is just a simplified visual of the most important parts for you. You probably are familiar with Form 1040. That is the main tax form for individuals in the United States. That's the one you have probably filed either as a single individual or jointly with your spouse over the years, right? That's the main individual US tax form. We'll also talk about very briefly Schedule A, which is where you will report any itemized deductions if you have them. And then we'll spend the bulk of our time talking about Schedule C or Schedule E. This is where you will report any ordinary and business income and all those ordinary and necessary business deductions associated with that business income, whether you are a sole proprietor or a member of a partnership, or if you have an LLC, right? So we'll spend some time talking about those different things as well. The first thing you have to think about, and one of the most important things to acknowledge as you start thinking about your tax return, is to really figure out, how are you making money? And for many individuals in the United States, they have what we loosely call a W-2 job. So this is a job where an individual is an employee of someone else. They are paid regularly, either on a salary or an hourly basis, and the employer withholds taxes from each paycheck for that individual. The employer also has to match some of the tax withholdings, and then the employer sends all of those withholdings to the IRS. At the end of the year, you get what we call a W-2. And for many individuals in the United States, that is as complicated as taxes get, because you report your income, the withholdings generally match more or less what you owe in taxes, and then you call it a day. For many creative individuals, though, it gets considerably more complicated, and many individuals do have W-2 income. A lot of the creative individuals I work with might have part-time jobs, or they might also teach in addition to selling or making work. So if you have these types of income, right, very often individuals will get a W-2 from these types of jobs, right? Your W-2 will show what you were paid during the year and how much was withheld for federal, state, and local taxes. If you have a W-2 income, all that information goes on the front of your Form 1040. And it is really important to understand how you are being paid and the different types of income you have, right? As I said, for most individuals, most people just have W-2 jobs and that's enough. But for creative individuals, you may also have income from freelance type of work or contract work or 1099 income. That means you generally control how you do the work and when you do it. You provide the expertise, someone else pays you, and then at the end of the year, they will send you a Form 1099. Now, when they pay you during the year, they are not withholding any taxes from what they're paying you. That's the biggest difference you see between a W-2 job and a 1099 job, right? And that feels really good in the moment because you get all of the cash you need. But If you are a contractor or a freelancer or self-employed, you are still responsible for those taxes. They're not being withheld by your employer. You have to proactively set them aside, report the income, and then pay the taxes at the end of the year. This comes up and this shows up on your tax return in a couple of different ways. I mentioned W-2 income shows up on the front of your 1040. That's the easy one. You are not, however, allowed to claim any ordinary and necessary business deductions associated with your W-2 income. Why? Because you are an employee of someone else. Now, once upon a time, and for those of you who have been managing your own taxes for a while, you may remember that you used to be allowed to deduct unreimbursed employee expenses on Schedule A. You are not allowed to deduct those anymore. And even when you could deduct them, they had to exceed a certain threshold. So for some people, it wasn't really a relevant deduction. But for people who maybe were paid as performing artists, for example, if you paid 10% of everything you earned to your agent or manager and you had a W-2 performing job, that was a pretty sizable deduction that you used to be able to claim on Schedule A. You cannot claim that anymore because that is an unreimbursed employee deduction and you don't get any deductions associated with your W-2 income, right? That was a big change under the Tax Cuts and Jobs Act a couple of years ago. So by now you've probably filed at least one tax return under kind of this new normal. So you might be already familiar with this. So that's W-2 world. Income, no ordinary and necessary business deductions, but that's okay because for most people, the employer is probably paying for most of the expenses anyway. You'll also see on the front of your Form 1040, if you have other kind of random income, so interest from bank accounts perhaps, or maybe you have investments that are paying dividends or capital gains, or if you get the occasional grant or award, very often you will receive a tax form from the person who gave you the award, but not always, right? That income still has to be reported somewhere though. And in some cases, it's reported on the front of your 1040. It's also possible that you report the income as business income and it'll show up on your Schedule C or your Schedule E. Either way is probably okay, depending on the type of grant or award, but that's something you're going to want to review with your tax advisor or whoever is preparing your tax return. For your Form 1099s, if you receive a Form 1099 and it's related to kind of your main business, the main creative work you do, you're probably going to be reporting that on Schedule C or Schedule E, depending on what type of creative business you are, right? It is possible that you will get a 1099 for something that's totally unrelated to the creative business you're running. And if so, that would just go on the front of your 1040, unless you were running a separate type of business, right? But for most individuals, most of the freelance work they're doing is related to their creative pursuits. So it goes on Schedule C or Schedule E. I'll also say as well, for many artists or creative performers, very often they are also selling goods. So if you are selling things, whether it is CDs or copies of a song or merchandise or paintings or ceramic vases, whatever you might be selling, as you are making those sales, you're not going to be getting a 1099 from the people who buy the work from you. It's your responsibility to track the income from the sales you're earning and report it on your Schedule C or your Schedule E. Then, of course, also on Schedule C or E, you do get to claim those ordinary and necessary business deductions. Why? Because you're not an employee if you're on Schedule C or Schedule E, you're running a business. And as a business owner, you get to claim those ordinary and necessary business deductions. I've mentioned Schedule C and Schedule E a lot here. As you think about the type of creative business you're running, let's take a moment just to hone in on what schedule might apply for you. For most individuals, many creative individuals are sole proprietors, meaning they are the humans that run their business and there's no separate business entity. Very oftentimes, they are also owners of a limited liability company, an LLC. And if you are the only owner, right, we treat that entity just like a sole proprietorship. We call it a single member LLC or a disregarded entity. If you are a sole proprietor or the only owner of your LLC, you're filing Schedule C to report your business income and your business expenses. If instead you have an LLC with other people, so a multi-member LLC, or you have a partnership, or you are part of an S corporation, in that case, you'll be filing Schedule E to report the income and expenses from your business. Now, those things are less common. They do come up in the arts pretty regularly, but they are less common than someone who is a sole proprietor or a single member LLC. Basically, these forms work generally the same way. You report your income, then you report your expenses, and then the net amount is what you've earned from your business, and that's what you end up paying taxes on, right? But we do want to make sure you're filing the right form. So keep in mind what type of business entity you are as you're figuring out where you're going to report your income and expenses. That was a lot all at once about income. So I want to pause here to see if there are any questions. You can certainly add your question to the chat. I have eyes on that. I can see it as you're typing them in. Or if you'd like to raise your hand or unmute yourself and ask a question, that is perfectly fine too. Okay, no questions. Go ahead and interrupt me if you do think of something that you want to make sure we cover. So far, we've basically just talked about how you earn income and where it goes. And the reason this matters is because for income that gets reported on your 1040, you don't get to claim ordinary and necessary business deductions associated with that income. But you do get to claim them for income associated with your Schedule C or your Schedule E. So keep that in mind as we go through some of these different examples. I mentioned Schedule C and Schedule E, and which one you file depends on which type of creative business you're running, whether you're a single member LLC or a sole proprietor, filing Schedule C, or a different business entity, filing Schedule E. In both cases, the net income from your business will flow from that schedule right onto the front of your Form 1040. That's why we call these flow-through or pass-through entities. These businesses don't pay their own taxes. Instead, they report income and expenses on the owner's tax return, their individual tax return, in this case, Form 1040. And of course, the big question that comes up when people are talking about taxes in particular, and especially business taxes, is what is deductible? So I thought we should take some time to talk about whether or not certain common expenses are deductible, and if so, what some of the parameters might be around those expenses. I use the analogy here of speeding when I like talking about deductions, and here's why. When it comes to driving your car, sometimes, occasionally, people will drive faster than the legally posted speed limit, right? And so in this case, we as humans kind of make the judgment that it's like, okay, I know I'm technically breaking the law, but it's okay. I'm making an informed decision about how fast I'm going to drive under these circumstances. And for many people, they're more comfortable driving quickly on the interstate than they are in a school zone. And there are a lot of really good reasons for that. Number one, you're already going fast on the interstate, so going a little bit faster doesn't seem like as big of a deal as it does if you're doing that in a school zone. It's also possible that lots of other people are going faster than the speed limit on the interstate too, so you're actually helping the flow of traffic if you're staying with it. The consequences of speeding in a school zone can be more dire as well, and there are usually higher levels of enforcement or higher penalties if you are caught speeding in a school zone, right? So all of these things go through our mind as we're deciding how fast we're going to drive, And the same is true for taxes. Tax laws are what they are. They set the parameters for what is ordinary and what is necessary and how we deduct certain business expenses, right? And it's entirely up to you to decide how aggressive you want to be when it comes to adhering to the letter of the law or the spirit of the law. So it's my job to make sure you have a good understanding of what the law says when it comes to tax deductions. And I will also help provide some context so you kind of know which ones are like speeding in a school zone where you have to be very, very careful and adhere to the letter of the law. Home office or home studio comes to mind as one of those examples. Or if it's the type of deduction where there's a little bit of flexibility or a little bit more wiggle room, depending on how comfortable you are. So that's the context as we go into this conversation. And I see a question from Amy in the chat. Amy, thanks for adding this. Her question is there a tax difference between operating as a sole proprietor and an LLC? The short answer is no. An LLC is a pass-through or flow-through entity, just like a sole proprietor is. So there is no tax difference between either of these entity types, especially if you are the only owner of the LLC. Now, if you are not the only owner of the LLC, there are still no tax consequences, right? You and the other owner or owners will still report your share of income and expenses on your individual tax return, but the geography of where that goes is a little bit different. So if you are the only owner of the LLC, absolutely no difference. You report everything on Schedule C and go along your merry way. If you have other co-owners of the LLC, you have to probably file a partnership return for the LLC, and then your information will show up on Schedule E of your own tax return. So, hope that helps. When it comes to business deductions, in general, any expenses associated with your business are deductible as long as they are ordinary and necessary, effectively connected to your trade or business, and not lavish or extravagant. So the IRS has helped us define these words. Ordinary is something that is common and accepted in your industry, and necessary is something that is helpful and appropriate for your trade or business. You'll see there's some room for interpretation in terms of what is ordinary and what is necessary. And what's interesting is that both of these definitions look to the industry or your own trade or business to help contextualize something that's ordinary and necessary, which means something that's ordinary and necessary for an artist might not necessarily be ordinary and necessary for a different type of business owner. So that's why this context of what's ordinary and necessary for you becomes really important. It's also your job to proactively supply the explanation of why something is ordinary and necessary if you're asked for it, right? That's why we want to make sure to keep excellent books and records that document the business purpose of each expense you have. It's that business purpose and the documentation of that that takes a regular expense and turns it into one that is effectively connected to your trade or business, and one that's also ordinary and necessary based on how you describe it. Now, you don't have to lose a whole lot of sleep over these descriptions, but it is important that you're proactive about saying a purchase of a book from Amazon is research for an upcoming body of work you want to pursue, or something like that. That level of documentation, again, make sure that this purchase is effectively connected to your trade or business, and it demonstrates that it's ordinary and necessary. The biggest hurdle when it comes to these deductions is figuring out, are you actually running a business? And when the IRS raises inquiries into tax returns, very often the inquiries relate to this idea of, is this really a business or is it a hobby? Now, that's an important distinction in the eyes of the IRS, because in the eyes of the IRS, if you are a hobbyist, then you may claim any deductions up to the amount of income you make from your hobby, but you certainly cannot claim more deductions than that. If you are running a business, though, it's entirely possible that your business may have a loss in certain years, and that loss can be used to offset other income. So what do we look at when we try to figure out, if you are actually running a business or if you are a hobbyist. One thing we look to is whether or not you are investing in yourself professionally in this business, right? If you're doing something just for fun, you're probably not going to be attending a tax webinar for the industry, for example, right? But going to a tax webinar on maintaining professionalism as an artist is an indicator that you are pursuing this thing professionally instead of as a hobby. Other things we look to are whether or not you're keeping books and records. Are you tracking your sales? Are you tracking income? Are you tracking your customers? Are you tracking your expenses and saving receipts for things that are associated with your business? All of those habits help sort of underscore the idea that you are doing this thing professionally rather than doing it just for fun. Because if you're doing something just for fun, you're probably not going to keep great books and records. The other things the IRS looks to are whether or not you have a website, whether or not you have a professional presence, whether or not you are attempting to make money from your work by applying for shows or applying for grants or awards or attempting to travel and better yourself in the field and seek out mentors and take additional classes. All of those things indicate that you are doing this in a professional capacity as opposed to as a hobbyist. So typically that tends to be the first hurdle that the IRS will look at. And so it makes sense for you to understand how to demonstrate that you are in fact doing this thing in a professional context. You are not required to form an LLC to do this, to be a professional artist, but that's another way that you can indicate that you are pursuing this thing professionally, right? A hobbyist doesn't usually form an LLC, for example. They just pursue something for fun. So those are the types of things we would look at to see if you really are running a business or if you're engaging in a hobby type activity. The second biggest hurdle we would look at is when you have an expense, how do you figure out which part of it is related to the business and which part of it might be a personal expense? And this becomes important because in tax world, your personal expenses are never deductible. But your ordinary and necessary business expenses are deductible, assuming you're actually running a business. So you can see how something like a cell phone service plan, right, for many people would be a personal expense and not deductible. But if you commonly use your cell phone in your business, and if it is ordinary and necessary to do so, then it's reasonable to say that a portion of your cell phone service is an ordinary and necessary business expense and should be deductible. So then the challenge becomes, what is that portion? How do I know how much of my cell phone is for personal use and how much is for business use? That's where this idea of bifurcation comes up. It is possible that you have two cell phones. One is just for business purposes, and that one would be completely deductible. The other one is just for personal purposes, and that would not be deductible to you at all. That's perfectly fine. That's probably not your reality, though. Most people have one cell phone, and they use it partially for business and partially for personal purposes. So one really good way of bifurcating that expense is to track your usage of your phone. Figure out how much of the time you're spending on it and how much of the activities you're doing on your phone are business related and how much are personal related. And then as long as it is at least 50% business related or more, then you can deduct the business portion of your cell phone. And this becomes interesting because phones are essentially small computers. Once upon a time, you could just look and see how many calls you had and whether the calls were business or personal. And it was a lot easier to distinguish that personal use from the business use. But now, with updating apps and using social media for both business and personal purposes and checking email regularly and maintaining a calendar, it's easy to see how the data and the phone is a little bit harder to track. But if that is a deduction that you are interested in claiming, it's important that you support the deduction by documenting the business use of your phone. I see a couple of comments in the chat, so I'll take a moment just to answer those. One of them from Kate, hi Kate, is attending a multi-day workshop far from home a business expense, including fees, travel, and per diem. Yes, absolutely. We'll go through some specific examples in future slides, but that is absolutely a business expense as long as the primary purpose of the trip is business related. So as long as that's true, you're perfectly fine. And then Nicholas has a question. Can I restate the comment about the hobbyist and how much business expenses you can allocate towards your hobby? Sure, absolutely. If you are a hobbyist, well, let me back up for a second. The general rule is that you must report all income from whatever source is derived. So let's pretend I am a harpist. I don't play the harp. I have no musical talent, if I'm being perfectly honest, but let's pretend I say, you know what, I want to learn how to play the harp. So I buy a harp, I start taking lessons, right? And maybe it's okay, but it's still just something I'm doing for fun, right? Maybe my neighbor says, Elaine, I know you play the harp. Will you come and bring your harp and play at my evening cocktail party next Saturday night? And I say, sure, that'll be really fun. So I take my harp to my neighbor's house. I play for a couple hours. My neighbor gives me $500. In the eyes of the IRS, I have $500 worth of taxable income. Why? Because I am required to report income from all sources, no matter how derived. So $500 in exchange for my time playing the harp technically counts as taxable income to me. But that's silly because I am just a hobbyist harpist, right? So what I would do if I were going through kind of the letter of the analysis is I would say, okay, that is taxable income to me, but I have well more than $500 worth of expenses associated with this hobby. So I don't have to report any income. I cannot, however, deduct expenses beyond $500, right? Maybe I spent $5,000 on my harp for the year, right? If I were in the business of being a harpist, I would have $500 worth of income and a $5,000 expense. So I might have a net loss for the year of $4,500, right? That's my $500 of income minus $5,000 of expenses gets me to negative $4,500. If I'm in the business of being a harpist, that negative $4,500 can be used to offset other income I might have, say as a teacher or as an engineer or as a CPA or any other type of income I might have. But that's only if I am in the business of being a harpist. If I'm just a hobbyist, I don't have to report the $500 because I had well more than that in expenses, right? Because again, I'm just doing it for fun. So I have my regular job and my regular expenses, but I don't worry about it. I hope that helped, Nicholas. If you have additional questions, we can follow up on that later. The reason this comes up for artists is that very often you will be in the business of being a professional artist and you will have negative net income for the year. You will have a net loss for the year for lots of very, very good reasons. So the IRS says, if you have a whole lot of losses, you kind of feel like Elaine the harpist that's doing it just for fun and not really trying to make money off of this thing, but is trying to look for a way to deduct what is really a personal expense and use that to offset other income I might have from other types of work I might do. That's the IRS's perspective. So that's why this idea of are you a hobbyist or are you a professional comes up in the arts a lot, because it is very common in the arts to have a net loss. That is to spend more money on your business than you make in a given year. Because as we all know, income in the arts can really fluctuate over time. You might have a great year or you might have a not so great year, and that's okay. So if those questions come up, the answer to the question, are you running a business or are you a hobbyist, is I am running a business and here's why. I'm applying for these things. I'm attempting to make money from my profession. I'm going to workshops. I'm trying to learn more. I'm seeking out mentors in the field. I have a website, all of those things that help support the idea that you are actually running a business. So let's talk through some of those details. Kate led us into this conversation perfectly. The first deduction I want to talk about is this idea of professional support. And if we were doing this live or all in the room together, I'd make you vote on whether or not you think professional support is deductible. But I'll just go ahead and tell you, yes, it's probably deductible. You want to make sure that professional support you're pursuing relates to your current industry, not a new one. And you want to make sure you're documenting the business purpose of the support. This could be something like your accountant, if you're paying your accountant to prepare your business taxes. It could be an attorney. You are asking for help in reviewing a contract or a licensing agreement if you're a musician, perhaps, right? All of this type of professional support definitely is deductible to you. As you think about hiring individuals as well, it's helpful to kind of flip the perspective a bit to understand if you are hiring someone to be your employee or to be your contractor, right? And you want to make sure they're clear on what that relationship is, and you want to make sure you're clear on what that relationship is as well. Hardware and equipment. This is generally deductible, and it's not usually that controversial. So what you want to do is make sure you're documenting the business purpose of the hardware or the equipment. I'm thinking of something like a computer, if you're a digital artist, or a Cintiq, or maybe this is an instrument or a stand for music. Maybe it's a new case for an instrument you're carrying. Maybe it is a large set piece if you're a performer. Any types of hardware or equipment is generally deductible as long as it's ordinary and necessary. If there is personal use associated with the hardware or the equipment, you want to make sure to bifurcate that deduction. This is like the example I shared earlier with a cell phone, for example. The same would be true of your computer if you use your computer for personal use and professional use. What many people do is retain a personal computer, maybe it's an older one to use for personal use, and use a newer computer for their business purposes. If that's not your situation, bifurcate the use of the computer, and maybe think about getting an iPad or a tablet or a Cintiq or something else that would be fully business related, and that's okay as well. I have a note on here as well that if you have a separate insurance policy on any of your hardware or equipment, that's probably deductible as well. So let's pretend you're a photographer and you have an amazing camera, and it's a really, really nice camera. And you look through your general insurance policy and you see that the general insurance policy will only cover items up to, say, $1,000. But this really nice camera is much more expensive than that. And you say, you know what, this is vital to my business. I'm going to get a separate rider or a separate mini insurance policy, if you will, to cover this particular camera. That extra rider would be deductible to you, right? So protecting the hardware or equipment is a business deduction as well. Software and subscriptions, these are generally deductible. Again, you want to document the business purpose of the software or the subscriptions. And when it comes to software or maintaining things digitally, you always want to be backing it up regularly, again, to protect yourself. And any digital backups you're subscribing to or paying for, that's probably deductible for you as well. Now, most softwares are pretty straightforward. Maybe you use a music editing software, or maybe you are a digital artist and you subscribe to Adobe, or maybe you really love Excel and so you subscribe to Microsoft Office, right? Those are all pretty straightforward, right? And the business purpose of those is probably pretty obvious. But it is possible that you will have a subscription that is less obvious. I subscribe to the Journal of Accountancy, right? That's not really pleasure reading for anyone, so that's pretty clear business purpose for me. But I have worked with creative individuals who ask if the business purpose for a subscription like Netflix is enough to justify deducting a Netflix subscription. And this is an interesting question because it gets into one of those, am I speeding on the highway or am I speeding in a school zone type of scenarios? So the way we would look at that question is to say, okay, a subscription to Netflix, is that ordinary? That is it common and accepted in your industry? I know that is not common and accepted in the world of accounting, but what if I were a writer and it were necessary for me to continue to stay on top of new television shows that I wanted to pitch for. In that case, it might be ordinary, that is common and acceptable in my industry. And then we would look at, is it necessary? Is it helpful and appropriate to your trade or business? Now, watching Netflix to kind of decompress out of a stressful day, that is not helpful and appropriate to a trade or business. It's not a bad idea, but it doesn't rise to the level of being a tax deduction. But if you have a scenario where you were invited to pitch a show for or pitch a couple of episodes for a show, or you're pursuing work writing for a particular producer, and you want to subscribe to Netflix for a limited period of time to learn the characters on the show and be up to speed so you can make an effective pitch, I think there's a valid argument there for why that subscription would be deductible in those circumstances. However, the facts and circumstances matter, right? So if you've been subscribing to Netflix for forever and most of what you're watching doesn't have anything to do with what you're pitching for, right? That's a harder argument to make. So hopefully that makes sense a little bit. When we're looking at software and subscriptions and anything really, we go through the analysis to say, is it ordinary? Is it necessary? Is it effectively connected to your trade or business? And then we make the decision of whether or not it's deductible. Creative supplies is another one that comes up all the time in the arts. Creative supplies are deductible to you, but when you sell the work, and this can be kind of confusing for individuals. So let's pretend I am a visual artist and I am a painter. When I buy my supplies and materials, those supplies and materials are considered assets to me. They're things I have, the canvas, the paints, etc., right? Those are my assets. When I turn them into works of art, those works of art are still an asset to me. They are part of my inventory. That is the stuff that is essentially available for sale, right? When it's still in my inventory, I still own it. But as soon as I sell the work, that's when the expenses I put into that piece become cost of goods sold or cost of sales. And that is the moment when those expenses technically become deductible. Before that, they're still your inventory. It's still an asset to you. So there's a timing issue when it comes to cost of goods sold or cost of sales. Schedule C has a great formula to help you kind of track this. And the formula starts with how much stuff did you have at the beginning of the year? And then it adds in what did you buy during the year, all those materials and supplies you may have purchased. And then it subtracts out what you still have left at the end of the year. And then the difference is your cost of sold, or cost of goods sold, or cost of sales. Now, some accountants will advise that supplies and materials are what we would call de minimis, that is, of minimal value. And so for them, those accountants often say, you know what, just deduct it all in the year that you purchase it. I gave the example earlier of a photographer. If a photographer prints photographs for sale, it does not necessarily make sense to track the cost of every sheet of paper and how many prints this person is selling, right? But if you are doing large scale installation work, or you're doing a commission where you are tracking your expenses associated with a particular piece, then it maybe makes sense to go through the exercise of tracking your cost of goods sold. This is a decision for you and your accountant to decide, okay, is it worth it to track it? And is that the most appropriate accounting treatment? Or are these supplies so minimal it doesn't make sense, and then you just deduct them all in 1 year? Bottom line though, your creative supplies are deductible. It just might have a timing issue depending on when you get to deduct them. Professional attire. This is one of my favorite ones to talk about because it usually surprises people. If you are wearing something that you could wear somewhere else, it is not deductible to you. I give the example of a jacket I might buy to wear to talk about taxes. It's my special tax jacket. It makes me look authoritative when I'm talking about taxes. This is just a black jacket. I could wear this anywhere. That is not deductible to me. The same is true if you are giving an artist talk and you buy a new garment, or maybe you buy something new for an opening that you're going to, or maybe a special show that you're giving. If it is a garment that you could wear somewhere else, it is not deductible. Now, there are some exceptions, right? If it is safety equipment, if it is an apron or gloves or goggles or steel-toed boots or some sort of protection for you in your studio, totally deductible, right? That is perfectly fine. If it's reference material, it's probably deductible. Let's pretend you're an illustrator and you want to focus a body of work on Marie Antoinette's dresses. And so you buy some corsets and some old-fashioned dresses, right? And you use them as reference material. You have a strong case that that is reference material and not attire that you would also wear. So that is probably deductible. If you are a performer and you have shoes that you perform in and you do not wear them out on the street, because if you did, you'd ruin the sole and you'd ruin the marley and it'd be awful, right? Your performance shoes are probably deductible. If it is a very specially made garment for you for something in particular, not a very special dress for you to wear to an opening, but instead maybe you're a violinist and you have a jacket cut with extra elbow room so that you can play appropriately, there's an argument that that could and should be deductible to you. But the general rule is, if you can wear something somewhere else, it is not deductible. I'll pause here to see if there are any questions on that. Sometimes that upsets people when they realize they can't deduct something. I'm not seeing any activity in the chat, so I'll keep going slowly. But I will share as well, what is interesting is the idea of renting a garment rather than purchasing one. Because if you rent a garment, you only have it for the business purpose at hand, and then you return it. There's a strong argument to be made that renting a garment is deductible, right? Because it's not something that you would then have access to wear for personal purposes. It's something that you would wear once and then send back. So that could be an interesting strategy for you to think about as you're managing the rental expense versus the tax deduction and deciding what makes sense for you. Research. Research is one of my favorite areas of deductions, but it's a little fuzzy. Things you purchase for research are probably deductible as long as they are ordinary and necessary and effectively connected to your trade or business. This means you need to document the business purpose of your research very, very well. Your best case scenario is research, whether it is a trip or materials you're buying or books or reference materials you're buying or anything like that. Your best case scenario is that you can kind of draw a very clear line from those supplies or books or experiences to a body of work you then create and sell for money. That is your best case scenario. Now, that's not always possible because some research doesn't necessarily lead to a body of work or kind of results in a dead end, right? Which is why documenting the business purpose of the research becomes really, really important. Things that go into this category could be going to a show at a museum, for an example, or maybe you're going on a trip because you're writing a play about individuals in southern Indiana, and you want to go and spend some time getting to know the population there before you write about them, right? Community engagement type of work may often fall into this category. All of this can be research, but you want to be very clear about documenting the business purpose of that research. Office supplies is our next category. This is not particularly controversial. Office supplies are probably deductible. Document the business purpose and then move on. These would be like pens, pencils, paper, etc., etc. All your general office supplies, probably deductible and not controversial. The same is true of your marketing materials. If you are printing show cards for something, or if you are sending out mailers, or if you are purchasing ads on Facebook for an upcoming event you have, all of those are marketing materials or marketing expenses that are generally deductible. And again, that's not very controversial. Some individuals put a subscription to MailChimp or Constant Contact or another newsletter service as marketing or advertising, and that's okay too. You just want to be consistent with what you're calling your expenses from year to year so that they show up in the same spot on your tax return. And of course, if you are spending money on marketing, it makes sense to know whether or not that's money well spent. So track the effectiveness of that. Home office or studio space is one of those red flag items that I mentioned earlier. This is the equivalent of speeding in a school zone. You want to make sure you are absolutely complying with the letter of the law for this tax deduction. Now, you are allowed to claim this tax deduction. I don't want to scare you off from claiming it, but I do want to make sure you understand the letter of the law to claim this deduction. The space in your home must be used exclusively and regularly for your business purpose. The exclusive part is the challenging part of that test to meet. Regular use is pretty easy to meet. If you have a space in your home and you are a visual artist and you regularly make work there, yeah, that makes sense. But what if it's also a guest room where people come to stay with you, say 2 or 3 times a year? All of a sudden, it's not exclusively a business space anymore. Occasionally, it's also a guest room, right? So that, in theory, would limit your deduction since the space isn't exclusively used for the business purpose. The space in your home has to be your principal place of business, and you can have no other place where you conduct administrative tasks related to your business. Now, these hurdles are sometimes challenging for people to meet. And again, the IRS gives this particular deduction extra scrutiny because normally your cost to live and your cost to exist as a human in your home are not deductible. We can talk about exceptions like deducting the interest on your mortgage on Schedule A, but as a general rule, your cost to live, your costs for your home are not deductible. So that means if you are using a portion of your home for your business, that's giving you an ordinary and necessary tax benefit, but it's one the IRS wants to give some special scrutiny to because they don't want the scenario where Elaine, the hobbyist harpist, all of a sudden gets to deduct a substantial part of her home expenses just by becoming a hobbyist harpist. So that's why it's an area of extra scrutiny. All that means is it makes sense for you to understand exactly what the law says when it comes to deducting your home office or home studio space. And publication 583 from the IRS, it's called Starting a Business and Keeping Records. It's a really well-written publication, and it has a whole section on home offices that you may want to go ahead and read. It's got a lot of examples in there that are really helpful. The other sort of quirky thing about this deduction is that it is specifically called out on Schedule C. For all the rest of your business deductions, they're kind of gathered in the middle section of Schedule C, right? They're not lumped completely together, but they're all kind of in one section. Then, way down at the bottom on its own line is the deduction for business use of your home. That's why the IRS is able to give it that extra scrutiny. It doesn't have to dig into the details behind any other lines. It is specifically called out on its very own line. So that means the IRS can automatically see who's claiming this deduction and does it feel ordinary and necessary. So again, this is one where you want to spend some extra time paying attention. Common questions that come up for this are often, how do I know what's the business use of my home and how do I document that? The most common way is to have a floor plan of your house, and it doesn't have to be an official one. You can kind of draw it out or sketch it out and then document the space within your home that is used exclusively and regularly for your business purpose. And this is especially important if you might move within the next 7 years or so, because the length of time when the IRS can examine your tax return is 6 years, which starts the year after you file it. So we're looking at a 7-year period. So it's a good idea to have that floor plan and save it in your tax files in case you move. It's also not a bad idea to take some images of the space when it's looking its most professional, of course, so that you can add those to your tax file as well. Again, because if you move within that time period, the IRS isn't going to be able to see the physical space, so you can provide the documentation for what the space looked like. Travel meals, and lodging. This was Kate's question from earlier. These expenses are generally deductible. As always, you want to document the business purpose of the travel, and the primary purpose of the trip has to be business related. We count it as travel if there is an overnight stay. If it's just a day trip, we don't count that as travel. You can still deduct the business miles as long as there's a business purpose for the trip, but we wouldn't have an overnight stay that would make it count as travel. I've also called out per diem rates here. There's a website called gsa.gov that gives per diem rates for cities all over the world. And sometimes those rates are better for you to deduct than your actual expenses. I've also called out here this unreimbursed employee expenses again. Let's pretend you are an employee and you teach at a college or university, and as part of that, you decide to travel to a conference. Maybe you tell your college or university about it and they say, that's great, we want you to do that. We can give you $300. And then you end up going and it ends up costing you $500. If you are going on that trip on behalf of your college or university, and you are a W-2 employee of that college or university, which if you're an instructor or a teacher, you probably are, then you may not deduct that extra $200 of travel expenses. Why? Because it's an unreimbursed employee expense. It's not associated with your business of being an artist. And this is where it gets kind of dicey, particularly for folks in creative fields, because if you're going to a conference on behalf of your college or university, yes, you are there acting as an employee of that college or university. But it's possible that the trip also has some professional benefits to you for your business of being an artist. So it would be up to you to determine what's the real primary purpose of this trip and how am I going to bifurcate these expenses between my employer and my own business. And that can be really dicey depending on whether or not you have a non-compete agreement with your employer or something like that. So this is an area where you want to make sure your records are really solid if you do kind of wander back and forth between W-2 territory and 1099 or Schedule C territory, so that you are very clear for yourself about what you're doing as an employee, because expenses associated with that are not deductible, and what you are doing in the context of your own business, because those expenses, as long as they're ordinary and necessary, are deductible to you. Business miles driven, I just alluded to, if you are driving somewhere but not having an overnight stay, or even if you are driving somewhere and your travel is business miles, these miles are deductible to you. Of course, you want to document the business purpose of the miles driven, and this same exclusive and regular test that applies to home office does not apply to business miles driven. So that means you can use your personal vehicle and drive for business purposes, but it doesn't have to be exclusive and regular business use of your car. It can be irregular and non-exclusive, which is a good thing. If you live somewhere where you have access to local transportation, like a subway or a bus system, that's great. You can deduct any expenses you incur associated with that public transportation. And again, you would just want to make sure to document the business purpose of that. And if you have an unlimited Metro card or an unlimited bus pass, you would want to make sure to bifurcate your business use and personal use of that particular asset. Documenting this is pretty important. You want to make sure you're tracking the business miles you are driving along with that business purpose. You can use a good old-fashioned log in your car if you want to write down the mileage. You can also use an Excel spreadsheet or any other log that will work for you. There are also apps that enable you to use sort of GPS tracking, and then you can sort of determine whether or not a trip is business or personal. You can classify it that way in the app. Mile IQ is the most common app for that. I describe it kind of as like Tinder for business miles. So as you're driving, or before you start driving, you'll get in the car and Mile IQ will say, looks like you're going on a trip. Is it business or personal? And you will swipe left or right to categorize the trip. And then the app will track your mileage for you. So if you're comfortable with technology and apps and having GPS enabled on your phone, that could be a really great resource. Just make sure to export the data from the app so that you have it for the entire statute of limitations of your tax return. Because what you don't want to have happen is to have the IRS start asking questions about your business miles driven and then open up your app only to discover the app is shut down or been bought by somebody else or doesn't exist anymore. So make sure you are retaining the information somewhere where you know you can access it for as long as you might need to access it. Business meals and entertainment. Business meals are still deductible. They are limited to a 50% deduction, which means you can deduct the cost of the business meal as long as it is ordinary and necessary and not lavish or extravagant, and as long as it is effectively connected to your trade or business. But you can only deduct 50% of the cost of the meal. That is just the limitation on business meal expenses, and that is the system under which we live. So keep that in mind. Entertainment expenses are not deductible anymore. That was a change under the Tax Cuts and Jobs Act. So this would be the scenario where someone, let's pretend you're a musician and you really want to work with a producer. And so you invite the producer to go to a hockey game with you, because while you're at the hockey game, you're gonna hang out and talk about hockey and really bond, and then the producer is gonna wanna work with you, right? That would be entertainment. Those tickets would no longer be deductible to you, right? So keep that in mind as you're deciding what you're going to do and how you're going to effectively network. Professional memberships are generally deductible to you. This is a membership to an art league or an art society or any other membership organization you may want to join. Often there's an annual membership fee that's deductible to you because you're in the business of doing this thing professionally. I will caution you to watch on your receipt. Occasionally, these membership organizations will say on the receipt, thank you for renewing your membership. $25 of your membership was used for lobbying purposes. That's telling you that that $25 is not deductible. So just as you're looking at your receipts, make sure to kind of note that so you know what is not deductible for tax purposes. I'll pause here to see if you have any other questions about common deductions that I didn't cover. If you have them, definitely throw them into the chat. And I'm glad that you learned about bifurcating, Kate. I think that's fantastic. I'll pause here and then we'll touch on a couple more things. We have about 10 minutes left in this webinar. Okay. I'm not seeing any questions. Feel free to add them and I'll keep an eye on it just in case you're still typing. As I mentioned, all of those deductions are reported probably on Schedule C or Schedule E, depending on what type of business you are. And the net income, so all of your income from your business minus all of those ordinary and necessary business deductions, that net amount flows through to the front of your 1040. And this is where you report the amount of income that you will then pay taxes on. But there's even more to it. There are some above the line adjustments you can make on your individual tax return that help you pay even less in taxes. I've called out a couple here, and if you were part of the webinar last fall where we talked about retirement planning for self-employed artists, these will probably sound familiar to you. There are two places here. This is on Schedule 1 of Form 1040, where you can make contributions to your retirement account, even if you are self-employed, or if you don't have access to an account through your employer, right? And there are tax advantages to doing that. Now, there are some limits. The limits change every year, and you'll want to make sure you're looking at this kind of holistically. So you're making sure you still have enough cash on hand and also taking advantage of some of the tax benefits to saving for retirement. And publication 560 from the IRS is a great resource to peruse further if you have questions on these. You can also go back and listen to that webinar. It's posted on the Indiana Arts Commission's website. I also wanted to call out on the same schedule, if you are making contributions to a health savings account, or if you are self-employed and you are paying for your own health insurance because you don't have access to other health insurance, there are some tax advantages to that as well. Publication 969 from the IRS is a good resource here. The last thing I want to make sure to draw your attention to is this idea of having itemized deductions or the standard deduction. Now, if you are an individual filing 1040, whether or not you're married or filing as a single individual, doesn't matter. Every human filing a tax return gets a standard deduction. Or you can choose to itemize your deductions if your itemized deductions add up to more than your standard deduction amount. Why? We want to take the bigger number because this is reducing our taxable income. So you want to take the standard deduction or your itemized deductions, whichever one is bigger. These are totally separate from your ordinary and necessary business deductions. And sometimes this is confusing for people because people think, well, if I'm not itemizing, I guess I can't have business deductions. Nope, that's not true. They're on a totally separate form here, right? You can see this visually presented. The standard deduction or your itemized deductions on Schedule A, that's an either or. You get one or the other, but not both. But your ordinary and necessary business deductions on Schedule E or Schedule C, that's an and. You get those in addition to either your itemized deductions or your standard deduction. So make sure you're kind of keeping that straight in your mind. Even if you are a taxpayer who always takes the standard deduction, still track your business expenses because that can still be a good tax advantage for you. After we reduce all of our adjusted gross income for the standard deduction or our itemized deduction, then that's our taxable income amount. And it's important that you have an awareness that all of these things we've been talking about are for federal tax purposes. And generally speaking, we use this taxable income number to inform your state tax return and your city tax return if you live in a city that does have a city income tax. So just keep in mind that there are lots of different levels of taxes in the United States, and it almost always starts with federal. Keep in mind as well, you might, in addition to having a city tax and a state tax, you might also have a school district tax or another municipality obligation. So make sure you're paying attention to that. If you do have those obligations, you are probably making payments to those different municipalities or the state or the federal government during the year. Many people make those payments through their W-2 job, right? So if you have a W-2 job, even if it's not your main source of income, you can ask your employer to withhold a little bit extra from each paycheck to help meet additional tax obligations you might have, like from the sale of your work. You can also choose to make estimated tax payments. The form for that is Form 1040-ES. This only kicks in if you are going to owe more than $1,000 in taxes when you file your tax return for the year. So for many individuals, especially if they have another W-2 job, either their own or through someone else in their household that's on the same tax return, most people make their estimated tax payments that way. But if your situation is such that most of your income comes from your own business, you are probably in the world where you want to estimate what your taxes will be, and Form 1040-ES is a great option to do that. So, what records are you supposed to keep for all of this nonsense that we've been talking about? I'm really glad you asked. As you are going through this process right now, you're probably looking at a stack of W-2 forms and 1099s you have from last year, and maybe you're pulling up sales records that you may have had, or maybe you're looking at your bank transfers to see who gave you money when they purchased work from you, or any other type of records, right? As you're going through that now, filing your 2019 taxes, pay attention to kind of what is annoying you about what you have to do to see if you can build some habits and practices for this coming year to make this process next year even easier. Great examples of this would be something like a mileage log, right? If you find that you can't really stay on top of that, maybe downloading an app like MileIQ and then figuring out how to get the information into an Excel file or a PDF file, maybe that's a really good practice for you to adopt. It's also helpful for you to pay attention to kind of where you're putting things on the tax return. If you're using QuickBooks or another system, you probably have some accounts set up. Make sure you know what those accounts mean. I'll give you an example. Some people have office expenses, and then they have a separate line called materials and supplies. Sometimes that's confusing because you see the word supply and you're like, wait, if I'm buying paper clips, is that a supply or is that an office expense? You get to decide, right? As long as you're consistent year after year. So maybe you write a note to yourself and say, okay, office expenses. This is where I put everything that is not a creative supply. And if you have that description sort of handy, that will help you going forward as you're categorizing things in your Google Sheet or your Excel spreadsheet or QuickBooks or whatever else you're using. So just pay attention to where some of your pain points are and see if you can solve them for next year. As you are saving your records, for each transaction, you want to make sure you are tracking and noting the date of the transaction, the counterparty, so who did you pay or who paid you, the amount of the transaction, and its business purpose. Now, those first three things are really easy to get. You can get them from your receipt, or your credit card statement or your bank statement. You can look back in your history and see the date, the counterparty, and the amount of every transaction. It's that business purpose piece that you have to proactively supply. Why? That's the part that takes a normal expense and turns it into an ordinary and necessary business expense that is effectively connected to your trade or business. So that's the part where you want to make sure you are proactively supplying that business purpose. You can do this in any number of ways. The IRS says you can use any system suited to your needs that tracks your income and expenses. So maybe for you, that is keeping paper receipts and writing down the business purpose on the receipt. That is perfectly fine. It's also possible to use a system like QuickBooks or FreshBooks or even Mint that is going to be importing all of your transactions. There's a note field in all of those different systems. That's where you can type the business purpose. And if you can get into the habit of typing those business purposes every time you update your system, it'll make sure your records are in really good shape. I've referenced publication 583 here again. This is the same publication we talked about earlier, Starting a Business and Keeping Records. It is excellent, and it has a whole section talking about the types of records you can keep. So it's worth a quick download. I've presented here a couple of different options. You really can use any system that works for you to track your income and expenses. QuickBooks is a fantastic one because it does what we call double entry accounting. So it's a really good option. FreshBooks is a great option as well. Its interface is a little bit prettier to look at. It's a little more design friendly than QuickBooks is. So many creative people prefer it. Mint, I mentioned as well. Be careful because know that since you're not paying for Mint, that means Mint is making its money somehow. And generally that is through anonymizing and selling your information to market research firms and others. Some people are comfortable with that, some people are not. So just make sure you're making informed decisions about which record keeping company you're going to work with. And if you don't want to work with any of them, there is Excel or Google Sheets or Numbers or any database software that you can use. There are about umpteen million more options out there as well. So if you have one you love, feel free to throw it in the comments or share it with IAC, and we'll make sure to update all of this. You need to retain this information for 7 years. That's because the official statute of limitations is 6 years if there is what we call a gross misstatement, meaning an error of 10% more or less. So Just in case the IRS alleges you have that big of an error, we want to go ahead and save all of your information for 6 years instead of the normal 3-year statute of limitations. And the statute of limitations doesn't start until you file your tax return or until it's due. So it starts on the later of those 2 dates. That means if you have never filed a tax return for a particular year, the statute of limitations for that year for you has never started, right? So you might want to go ahead and think about doing that, or at least know that there might be some tax exposure there. If you file your tax return for 2019 by, say, April 15th of this year, that means your statute of limitations will end in the year 2026, which is why we say save everything for 7 years, the year the transaction happens, and then 6 years after that. My best tip is to schedule a little bit of time each month or maybe each quarter, depending on how many transactions you have, to update your books and records and just stay on top of all of this. It's also helpful to have a separate bank account so that you know all the information there is going to be business related and you can update it as needed. I'm going to take a peek at the chat here to see if there are other questions. There's one from Alan and Karen. You've read that the IRS says it's necessary to show a profit for 3 out of the last 5 years to be considered a business. If you don't have a profit, should you only claim expenses up to the amount of profit? I'm so glad you brought this up. Yes, that is absolutely right. The IRS has what it calls a rebuttable presumption that if you are not making money 3 out of every 5 years, their assumption is you're not really running a business. But that is a rebuttable presumption. That means the IRS will likely ask questions about it, but you can refute their assumption that you're not really a business by doing some of the things we talked about earlier, by demonstrating that you are actively seeking to make a profit, by keeping those excellent books and records, by attempting to improve in the field by taking classes or pursuing professional memberships or other types of organizations, and then just by kind of explaining to the IRS that, you know what, we didn't have a profit in this year and here's why. Maybe it is the cyclical nature of funding. Maybe it is that you actually made a lot of money, but you reinvested a lot of it in your business, so it doesn't look like a profit, even though you made money. There are lots of valid reasons for why you might have a loss more than 3 out of every 5 years, but the IRS is going to assume that you're going to have to explain that if you're going to have those losses. Rebuttable presumption. So that's one of the things to think about. To the second part of your question, should you only claim expenses up to the amount of profit? That's up to you. Legally, you are entitled to claim all of the ordinary and necessary business expenses you have that are effectively connected to your trade or business, but that does increase the likelihood that you will be audited. So that's a decision for you and your accountant to kind of work through to decide whether or not the risk of audit is kind of worth accurately tracking everything for tax purposes. My general assumption is that, yeah, you should report all of your income and all of your expenses. And as long as you can explain why something happened the way it happened, you should probably be fine. I see another comment here from Kathy. Kathy uses Artwork Archive, which is wonderful. I love that you're sharing that resource. Kathy shares she's a visual artist, and it's a one-stop shop for assisting with recording everything in one place, including all of your inventory items, I imagine, which is really, really wonderful. Kate has a question, which is what happens if you are audited? It is not nearly as scary as you think. Generally speaking, you receive a letter that says someone has some questions about your tax return, and then you answer those questions as they're presented. Usually you can answer them in writing. If that's not enough, sometimes the IRS might ask to come and look at some of your books and records, and then they'll make an appointment to do that. If you have representation, meaning someone has prepared your tax return, either a CPA or an enrolled agent or another tax preparer, generally that person will be helping you through the audit process because they will have all of your books and records as well. But it really isn't as scary as it sounds. The most important thing is, though, if you do get that letter, go ahead and open it and see what the questions are as opposed to just ignoring it. I will take a moment now to thank the Indiana Arts Commission and Anna in particular for facilitating these types of conversations. I will stick around for another minute or two if there are additional questions, but I do want to go ahead and wrap this up since I know many of you have other evening plans to get to. Thanks so much for spending some time with me this evening. If you have additional questions, please feel free to follow up via email, and stay tuned because the Indiana Arts Commission is going to be sharing a recording of this as well as a copy of the slides for your records.
That's exactly it. I have nothing else to add. Thank you so much, Elaine. Thanks to everybody else for joining tonight. Go forth and do tax as well.
Go forth and do tax as well. Thanks, Anna, for taking us out on such a flawless note. Thank you very much again, everyone. I will look forward to seeing you all again on our next webinar, whenever that might happen to be.
I don't know either. Stay tuned. We like to keep you on the edge of your seat.
Absolutely, yes. I bet we'll think of more interesting tax or other finance topics to talk about. All right, seems like no more questions, so we'll go ahead and stop and close out everything here. Thanks for all the thanks, and yeah, we'll talk to you again very soon. Bye, everyone.